I mean, you know that there are lots of things that have to be done with finances in parishes, you know, budgets, reports to the vestry. And my goal tonight is to help you see those not as a list of separate kind of unrelated tasks that have to be done, but things that if they're done well will help you lead, will help you move the parish in a more constructive direction, because leadership is not about getting through the month or the year. Leadership is about moving to a better place with the institution, and so that at the end of your tenure, you're handing on to your successors an organization that's stronger than it was when you became a leader in it. And I don't buy any kind of dichotomy between administration and ministry. They come from the same word, and something that is well administered and transparent is going to be a better vehicle for ministry. We're going to be talking about a lot of things having to do with finances tonight, but I wanted to make sure that you had in your heads the different ways that we ask for money from people and the different purposes for which those funds are used. Ordinary or annual giving is what we ask for every year, mostly in the form of pledges. It's called annual giving because it comes generally from people's annual income, and it's used by the recipient organization for its regular annual operating expenses. Extraordinary or capital giving, major gifts, it's a specific intense time of raising a significant amount of money, usually to acquire property or to build or renovate property or to build endowments, sometimes also to pay off capital debt. Capital giving because the major gifts that make a capital campaign possible usually come from the accumulated capital that your members have, and they're not spent by you on annual expenses. They're added to your capital either in the form of land or buildings or endowments. And ultimate plan giving is a decision to give is made in advance, but it's usually the death of the donor or of some other person that actually triggers the gift. So it's a gift that is made with forethought and planning, and it generally, well, it shouldn't be thrown into the operating budget, and it generally can't be used in a capital campaign because you're raising the money at a particular time. And because planned gifts, ultimate gifts, are usually solicited with the idea that they'll help propel the institution forward over time, I think they're best treated as principal contributions to an endowment fund. Okay. Now, why should parish leaders care about finances and that? Because healthy finances, first of all, enable ministry now. They make it possible for there to be a future, and they impact what present and future leaders are able and are going to be able to do. So having a healthy operating budget, and we'll talk about what makes a healthy operating budget right now, is actually also a step for the future, because everything that you do as a leader is to build a stronger future. And a stronger present, if it's really stronger, is going to be a better base to build a stronger future on. So what is a healthy financial operation? I would identify it as at least these things. First of all, the budget provides, the expense side of the budget provides for sufficient staff and the resources for a thriving operation. This is very important. Most of our parishes are way underfunded. The budget doesn't provide for enough clergy time. It doesn't provide for enough program and administrative staff. So keep in mind that even though your budget may be balanced, it may still also be underfunded. A healthy financial operations means that you're able to pay for the staff and the resources that you need, not to be a subsistence organization, but to be a thriving organization, and that you've identified sufficient revenue streams to fund that level of staff and resources, and the budget is realistically balanced. Now, this one, many parishes depend very heavily on either endowments or rentals or some other funding source. A healthy parish derives somewhere in the area of 3/4 of its income for the operating budget from individual contributions. Now, you may think to yourself, well, we get 90% of our budget from individual contributions. Yeah, but your budget may not provide for more than a supply priest or a half-time priest when 20 years ago you had a full-time priest. Remember that 75%, it means 75% of the income needed to fund a thriving operation, not necessarily the operation that you're funding right now. And that in addition to this kind of budget that provides enough resources, that has enough income to pay for it, and that shows buy-in and stakeholding by your members, they're not depending on other people's money to pay for it, you also have identified some stream of income that does not go through the operating budget, that goes directly into a capital reserve fund so that you do not have to defer maintenance on your buildings and you can keep them up. Okay? Now, much of what I'm saying may be challenging, and we'll get to the comfortable words in a minute, but we have to hold out the goal that we're working towards so that we know that we've got a direction in which to move. Very often, because our budgets are underfunded, and they're not, even in that case, they're not realistically balanced, and we're not funding for capital improvements, we often try to hide the reality of our situation from ourselves so that we don't have to think about it at every vestry meeting. Jim? I'm pressing here, but the next thing isn't coming up. Okay, sorry. First of all, we might adopt an unbalanced budget. We might, have an expense side that may be close to what we'd like to have, but we haven't been able to identify the income stream to pay for it. But we might call it a challenge budget or a faith-based budget or something like that. There's nothing faithless about recognizing the realities that we actually face today and dealing with them. And if you are if you're a leader and a good leader that feels a little shy about money, and maybe you don't understand it, some leaders have a tendency to try to deal with their discomfort with that area by saying, well, God, treating any discussion of financial realities as a lack of faith and to try to shut down the discussion. Don't do that. The discussion can be constructive. It doesn't have to be negative. It doesn't have to be fearful. Anxiety is the opposite of leadership. And so even in a bad situation, we have to manage our anxiety levels and try to chart a path toward, what can we do right now that will start to move us in a better direction? Jim?
Is it now?
Okay.
I moved it there, so if it isn't moving, let me know. It should work.
Okay. All right. And another way that that parishes kind of regularly hide the reality of the situation from themselves is by actually failing to provide the vestry with complete, concise reports that have the information necessary for the vestry to understand the situation and to make good decisions. So providing useful reports. I'm talking about now your revenue and expense statement. Sometimes you might have a program that alphabetizes all your categories, and so they're not grouped together like things with like things. They just all appear in alphabetical order. To have a useful report, you need to group similar income and expense items together and to come to subtotals. So plate, pledge, special contributions, holy days, that's all comes to a subtotal called individual contributions. All the people that might use your space from AA groups to a nursery school to whatever, that's space use income. On the expense side, personnel, program expenses, plant operating expenses, office expenses, that kind of thing, so that you can look at chunks of your budget and see how big they are relative to the total and so forth. If you have just a list of unrelated, where personnel and postage come right after each other, it's going to be harder to make sense of the report and to make get anything useful out of it. The report should not exceed 2 pages. That doesn't mean that you should leave information out. It means that if a line does not equal 1 or 2% of total income or total expenses, it probably doesn't need its own line. It can probably be added with other stuff, like postage can be included with operating expenses, or the water cooler in the hall can be included with plant. And you want to have these 4 columns in your report. So we've talked about how to organize it down the page. Now you need these columns going across the page. And I think you need all 4 of these, and you don't need any others. And if you don't have all 4, there are questions you can't answer. And if you have more, your eyes are just going to start rolling round and round, and the report will lose its usefulness. First of all, the main question that people have to know is, how are we doing so far this year? So year-to-date actual, not how did we do last month, because monthly income and expenses vary so widely that you can't really make anything out of it. So if you're at the June vestry meeting, the first column is January through May. The second column is to answer the question, how did we think we'd be doing at this point during the year? So the second column is your current year-to-date budget. So if it's the June vestry meeting, the first column is actual results for January through May. The second column is 5 months of your current budget. And whether it's just each budget line divided by 12 multiplied by 5, or whether you try to seasonally adjust it somehow, anyway, the second column is the year-to-date budget. The third question you want to know, I think it's pretty logical, is are we doing better or worse than last year? And in order to do that, you need last year's actual January through May results. And the final thing is, where are we headed so far? What are our targets for this year? So you need the total current budget, all 12 months. And I don't think you really need percentages or variances or stuff like that. Your eyes will see, as you just read across, particularly those bolded subtotals, whether total individual contributions are hitting budget, and whether they're up or down from last year, and whether you're on track to make the current year's targets. So now on the income side, what are sort of the hallmarks of a typical healthy operating budget? Now, of course, typical, these are not like rules. These are not canons. These are just things that I've seen looking at hundreds and hundreds of parish budgets. The current congregation is going to be funding around 3/4 of the total operation. That's one thing where you know that people feel like it's their place, they're involved in doing it, their contributions really matter. So individual contributions are going to be funding 75% around of the budget. Now remember, I'm talking about a well-funded budget. I'm not talking about a budget where you can't pay a priest and are always in trouble with the insurance company. That's an underfunded budget, and you just need more income, whether it's from people or anything, to make the budget work better. Rentals and fundraising events can be an ancillary source of income. Around 25%. And this to the Tom in Chicago, my recommendation is, to the extent that it's at all possible, to use no investment income in the operating budget. There are risks in using endowments to fund operations. I think there's a slide that's coming up where we can go into those a little bit more. Use the drawdown from your investments to fund your capital reserve. Try to wean the operating budget off of its reliance on investments and direct the income from your investments into your capital reserve. Most parishes need to be reserving, most parishes are reserving nothing for capital needs and are trying to take care of whatever pops up out of the operating budget. The amount that we need to set aside for capital needs is far greater than you might imagine. So if you have any investments and you can keep yourself from using them in the operating budget, use them to fund your capital reserve.
Jerry, can I, before you
Sure.
go on, just two quick things. One, would you say that funding special ministries that are outside of your operating budget is certainly a place where one could use endowment income?
Well, sure. The reason, it's not that endowments are bad. I think endowments are very good. It's that most parishes that have them do a bad job of preserving them. And if it's used for a current purpose, whether it's the operating budget or a ministry or program outside the operating budget, it's very easy for you to think, well, we need it now, and so we'll use more than we should, and you end up shortchanging the future. And since my idea is that endowments are part of your permanent patrimony, you need to set it up in such a way that you do not overdraw them. You do not spend more in any year or over a period of time than is sustainable, than you can make back through your investment activity. One of the reasons not to use investment income for operations is that your parishioners begin to think, with very good reason, that they don't have to give because other people's money is going to pay for this. And I'm perfectly willing to let other people's money pay for something that I want. But that leads to a lack of sort of buy-in in the whole parish. That's the kind of thing that leads parishioners at the coffee hour to talk about the vestry as they rather than as we. And on the other hand, if the vestry is sitting around the table and they're thinking, we'd like to do this, and somebody says, well, I don't think a lot of people are going to want to give money toward that, and somebody says, well, we don't have to ask the people for money. We'll just take it from the endowment. So you're feeding that idea that you're not accountable to each other. We don't have to make the case for what we're doing. We can just spend the endowment. When you're using the endowment for an operating purpose or for a program purpose, the main way that people start to overspend their endowments, if they aren't doing it already, is the market turns down. And all of a sudden, you had $2 million and you were taking a reasonable, although now it's considered a rather high, 5% out every year. So it was producing $100,000 a year. The markets go down, and all of a sudden you've got $1.5 million, from which you could safely take, say, 75. But you don't want to make those budget cuts, and maybe giving drops because of hard economic times. And so you take out at least the $100,000, and maybe you take out a little more just this once because we really need it and the extraordinary circumstances that we have. Once you do it once, it's very addictive behavior. It's very hard to stop. If your endowment draw is funding your capital reserve and the markets go down, sorry, I just saw a note that I should have seen some time ago.
When you're finished with this section, I was going to ask you that question. So
Okay, all right, okay. I'll get back to it then, Helena. The if your endowment draw is funding the capital reserve and the markets go down and the draw diminishes, that's okay. You can put the brakes on your capital program. There are very few capital projects, if you're keeping up with stuff and you're executing a capital plan, there are very few projects that you can't, postpone for a year or two if the capital reserve funding dips somewhat. But if it's a budget, whether it's a special ministry or the operating budget, cutting the budget generally means cutting staff, and that's much more difficult to do, and we're much more likely to overdraw the endowment rather than to cut back somebody's hours or eliminate a position altogether. So it's much better not to have the endowment funding programs and operations. And finally, when people, I've seen this over and over again, when people are so used to overspending the endowment and taking whatever they need out of the endowment, they stop being able to think about where else they could possibly get the money. Well, we just have to take it from the endowment. Well, what would you do if you didn't have the endowment? Well, then you start to think the way parishes without endowments have to think every month, and you can actually get creative and start making the case to your donors about why they might want to increase their giving and stuff like that. So frozen thinking is another reason not to use the investments in your operating budget, because it'll keep people thinking about where can we get the money for this? How can we generate the revenue for this thing that we want to do? Okay.
Jerry, if you could address the cash versus accrual question before you continue.
Actual. Whether you're on the cash basis of accounting or the accrual basis of accounting, of course, most parishes are on the cash basis, money in, money out. If you're on the accrual basis, that's great. I prefer books that are kept on the accrual basis. Whatever basis you're on, your results for whatever period we're talking about. Doesn't have to be cash.
Thank you, Jerry. There's one quick question before you go on to explain, since you brought up the issue about endowments, which I've posted. What about restricted endowments where it must be used for something like maintenance or something that is part of the operating budget? You still spend it.
If you've got a donor restriction on the money, somebody gave it to you with the idea that I want to make sure that there's always a priest here. So this money has to go toward the priest package. Okay, use it toward the priest package, but don't ever overdraw it. Don't ever take out more than is a sustainable percentage. And most people, you have to have it invested. If you have it invested only in bonds or interest-bearing accounts or something like that, then you can't even use all that interest. You have to leave enough in there to make up for inflation. So most investment programs, in order to produce anything at all, especially since interest rates have been so low for the last 5 years, they have to be invested in stocks. And so there's going to be ups and downs in the stock market. The balance is going to go up, it's going to go down. You have to be able to cut what you take out of the investments toward your operating budget when the markets go down. Otherwise, you're going to be overspending them, and you're not going to be preserving them. And 30 years from now, the people are going to say, well, yeah, we had this endowment for the priest salary, and they gave us, $100,000 in 1910, and it paid for everything. And now we've got $125,000, and it pays for almost nothing. That there's a long-term effect to not preserving the value of your investments. So if it's a donor restriction, and you accepted the money, then you have to abide by the donor restriction. If it's a vestry designation and the vestry decided we're going to do this with the money, well then the vestry can decide to do something else. And I would, if it's a vestry designation, I would encourage the vestry to wean the operating budget off its reliance on the endowment and fund the capital reserve with it.
Okay, thanks, Jerry.
Okay. on the expense side of a budget, I would say that, I mean, these are some kind of more like diagnostic tools rather than mandates. Personnel should be an enormous percentage of your budget, because in any not-for-profit, it's the people that are providing the work, and so the total personnel, lay and ordained, program, administrative, maintenance, clergy, everybody, all in, salary and all benefits, is very likely going to be 55 to 60% of your budget. If your priest, all by him or herself, and her package is costing more than 50% of your budget, you're in trouble. Then you're being so stretched that you don't have enough resources to have the adequate staff to support the priest. And the building, if the building, not counting the sexton, but insurance, maintenance, utilities, if all of that is costing more than 25% of your budget, you're probably feeling pretty stressed about it. And there are plenty of parishes where you add together the personnel, the priest, and the building costs, and you've got 95% of the budget right there. And that means, of course, that you can't be doing anything. You can't be having, much of a Sunday school program or any kind of outreach. You probably are trying not to pay the assessment, and, So 55 to 60% all salary. Building operation, no more than 25%, and that leaves you 20 to 25% for program. And then, in addition to that, you're funding a capital reserve from a source of income outside the operating budget, and Jim, what does this last one mean? Is that a reference to a narrative budget?
Importance of talking about impact when you're talking about spending. This is the ongoing thing that we're always preaching when we're talking about raising funds for mission and ministry, whether for a capital campaign or for whatever you're doing. More and more today, as the people in your congregation are changing and you're receiving more and more people who just do not assume that the church is worthy of receiving funds just automatically, more and more important that you are showing that there is a difference from the work that you're doing in your parish, and that's what Jerry has been talking about in your program, and clearly making it clear that you are making a difference in the lives of your parishioners and in the lives of the greater world, so that people understand its impact. So that's what that means.
We're doing like the back room vestry table stuff here. When you're talking about raising money from your parishioners for the budget, you don't want to talk about the insurance bill and the workers' comp. You want to talk about what the money actually produces. What are we able to do because you're giving us this money? The choir, the Sunday school program, the acolytes, the food pantry. You're gonna say these are the things. Your money, yes, it pays all these bills, but what it's actually doing, it's doing that work. That's where your dollars are going. It's the way public television doesn't tell you that your money is paying for rent or medical insurance. It tells you it's making these programs possible. Thank you for making these programs possible. That's the connection you have to make. Now, I've outlined. I hope to some extent that I've challenged you. I imagine that many of you are not dealing with an operating budget that is well-funded, thriving, is funded, and at that level is funded 75% by your members, and that you have a separate stream of income that's funding a capital reserve. That's okay. It's all right. Every journey starts with a step. If you know, though, that this is the direction that we want to move, then you'll be able to see how you can take steps toward it and sort of take hold of how we're going to move into the future rather than just letting the future come at us because we're not prepared for it. Leadership is the slogging work of year by year taking another step toward this goal, maybe this year being able to take 2 steps, maybe next year having to draw back a step because something happened, but you don't lose sight of the prize, and your eyes are on the prize, and that is going to keep you moving toward it. And if your eyes weren't on the prize, you'd just be running in circles or moving backwards. That's why it's important to have something ahead of you that you're working toward. And any progress that you make is going to make the parish healthier. Anything you do along the lines of what we've discussed so far is going to be a help, even if you're not able to get all of the way to where you want to be. And your successors will thank you. Instead of being, I'm sure you've had discussions where you've said, well, why did they do that? Why didn't they think about that when they were doing that? Why did they let things get to this point of view? You want to be the group of people that they said, oh, yeah, that's when things started to get better. That's when we started moving in the right direction. Those people got it right, and we're grateful to them. We've had a little bit. We've already mentioned it. You've got if somebody just gives you money, your governing, with no restrictions attached, your governing board is able to decide, we'll put the money toward this. We'll treat it as a building endowment. We'll invest the money, and we'll use the income to fund the capital reserve. Or we'll use the income from this for a scholarship fund or something like that. And what one vestry decides to do, another vestry can undo, and that's perfectly okay. If somebody has given you money with any kind of restriction, telling you you can't spend this money ever, you can only spend the income from it, and when you get income from it, you can only spend it on, as in one parish, prayer books, hymnals, red pew cushions, and purple altar hangings. That's what the money could be used for. They took the money with those restrictions, and therefore that's what the money had to be used for 100 years later. Donor restrictions are permanent, and the only way, and if it was something that somebody willed to you and it came in their will, the only way you can get a donor restriction changed is by going to court and getting a court to agree that the restriction is either obsolete or onerous, and getting it broadened. In the Diocese of New York, there was a fund that was given in the 19th century to supplement the salaries of clergymen paid less than $300 a year. In the 1990s, when the diocese went to court to open up the restriction, the donor had not been able to understand inflation or the ordination of women, and now the restriction is to supplement the salaries of poorly paid clergy. So if you do get a restricted gift, if you're able to talk to the donor about it, and you're able to make the restriction something that you believe that 100 years from now the parish will still be able to live with. And of course, you don't have to, if the restriction is too onerous or you don't want to do it, you don't have to accept the money. But if you do accept the money, then you've accepted the restriction. In perpetuity, you're binding all future vestries to abide by that restriction.
Gary, before you go on, I just wanted to also throw out there that the Episcopal Church Foundation is happy to share our own endowment and gift acceptance policies, which help parish leaders deal with many of these issues. One of them, and one way to help stop people from creating so many restricted gifts, is to put a threshold on that gift. So someone needs to give up to a certain dollar amount, because in addition to the restriction on it, you also have to account for it separately, because it ends up being a restricted fund, and restricted funds have to be accounted for separately, and you don't want to have a large number of very small funds, which then you have to spend the money and time to account for them. So just a side comment on that the Episcopal Church Foundation is happy to help folks with too. Carry on, Jerry.
Yeah, good. That's one of the things that it helps to think about in advance. The same way that you want to think about in advance, what would you do if somebody left you a bequest? What would you do with it? What would you use it for? Would you treat it as a principal contribution to a capital endowment, a building endowment? How would it be invested? Who would invest it? If you have all these decisions made ahead of time, then you can tell people this is what we do with your gift, and your case for being somebody that an organization that somebody would leave money to in their will becomes stronger. If you have investments, you are either probably overspending them now, or there's been a period in their existence when they have been overspent. If you are overspending them now, no matter what purpose you're using them for, it's very difficult to stop because you're used to having that kind of money. You've stopped thinking about what kind of percentage are we taking out of the investments, and you're just thinking, we need $150,000 this year. I've met with plenty of parishes, that are 6 or 7 years away from running out of money. They are almost never, at that point, are they able to stop doing it. They're able to stop doing it when they're like 1 or 2 years away from running out of money altogether. If you're overspending your endowment, if you're taking out more than 5%, if you're taking out 8, 10%, you really owe it not only to yourselves but to the future of your parish to take every effort you possibly can to stop doing it. It's one of the things that although it's difficult, it's one of the things I like talking to parishes about the most, which is good because I get to talk to them a lot about it. First thing is stop thinking about what you're taking out as dollars. We need $150,000, and calculate it as a percentage of a 3-year average. In other words, to figure if you're taking out $150,000 in 2013, go back and look at the December 31st statements for 2012, 2011, 2010, average those year-end balances, and then figure, okay, is $150,000 3%, 5%, 15%? How much are we actually taking out? And start thinking only in those percentage terms. Right now, this year we're taking out 13% of a 3-year average of the fund. A sustainable takeout is 5%. So how are we going to get there? Year by year, you start then ratcheting down that percentage. If it's at 13% this year, then next year, say, okay, we're going to take the average of 2011, 12, and 13. We're going to multiply that average by 9%, and that's all we're going to take out for any purpose whatsoever. That's it. We're going to either have to develop other income streams, or we're going to have to cut the budget temporarily while we figure out where to get the income, but we're going to get on top of this overspending, and we're going to cut it from 13 to 9, and the year after that 8, and the year after that 7, and the year after that 6, until we get down to a sustainable percentage. No more than 5, although most universities and not-for-profits these days are doing 4 to 4.5%. And in other words, you know that if you're using your investments to fund the operating budget, you know that although pledges can grow, right now, this is $60,000 is all we're going to be getting out of pledges this year. And we know that we can't tell the nursery school that's paying us $12,000, we can't tell them, well, next year you're going to pay us $30,000. We know that 12 is all that we're going to be getting out of that. Every other stream of income you have is limited right now. It's not limited permanently. It can grow, but right now it's got a limit that you can get out of it. You have to start thinking of what you take out of your investments as one more limited stream of income. And where you've gotten into the bad habit of overdrawing is you're able to treat that as a bottomless fund that you can draw from. And unlike your people and unlike your tenants, the endowment doesn't scream when you try to take more out of it than you should. So you have that discipline has to come from you. It's not going to come from them. And then you start to think, okay, we still need to pay a sexton. We still need to do building improvements. Now, where are we going to get the money? Where would we get the money to do these things if we didn't have the investments? And this may take a while. And depending on how frozen everybody's thinking is, you may need to have somebody else come in and sort of prime the pump a little bit to get the cogs moving again so that people can think about how they can get money in another way than calling the broker and saying, send us another $5,000. I've talked a lot about reserving for capital needs. Let's just take a minute here to, you're all sitting down, right? Let's talk for a minute about the amount that you need to be reserving for capital needs. I hope you all have, I hope most of you are using church insurance as your insurance carrier for the buildings. If you're not using church insurance, I hope you're using another carrier that is providing replacement value insurance. In other words, if you have a loss, they won't give you the depreciated value of what was destroyed. They'll give you the money to replace what you had. If you have a replacement value policy, in the policy it says what they consider the replacement value of your plant to be. This is going to be in the millions of dollars unless you're a tiny, tiny, tiny little place. Let's say that you have a moderately large plant with a church and a parish house and a rectory, and the replacement value is $5 million. The building maintenance professionals say that you need to be setting aside 2.5% of your of the replacement value of the buildings every year.
Now, are you going to give us some more comfortable words, Jerry, now that you said that? Because I had to pick myself off the floor.
Right. See, even if your plant is worth only $1 million, and almost nobody's plant, I mean, it would really have to be a tiny place to have a replacement value of $1 million or less. We're talking about $25,000. If it's a $5 million plant, we're talking about $125,000 a year. And many church plants are worth. And remember the rectory. If you own the rectory, that has to count in there too. And you have to, and you owe it to your rector and to future rectors and to your own sort of self-esteem to be a good landlord and keep the rectory in good condition, keeping doing the capital improvements that any normal tenant would expect a landlord to do. So that's why you need a building endowment, and that's why you need that money going into a capital reserve so that you are not getting further and further behind by deferring maintenance. And when you are deferring maintenance, if you get to the end of the year and your operating budget doesn't end with a surplus or a deficit, and you have done no capital improvements to your buildings, your budget is unbalanced. You have shown a loss. You have funded the loss by borrowing from the buildings. In other words, you haven't done work that year that the buildings really needed. And you can get along that way for a while, and then at a certain point, the building will start to demand repayment. And then you'll start to understand how expensive that loan actually was and what a high interest rate it had. So you owe it for your own peace of mind, you owe it to yourself, you owe it to your successors to begin to address this situation, to start to get on top of it. If you have a line in your operating budget called major repairs that you put in there because you know that things can go wrong, and you try to make it through the whole year without spending any of it, and you think, whew, we got through a whole year without having to do anything with the buildings. Maybe we actually don't need to have $10,000 in that line. Maybe we can cut it to 5. No, keep it at 10 and transfer it from your operating account to a capital reserve account, and then make your repairs from there. And next year, make sure you have at least 10, try to make it 11. Transfer it to the capital reserve, while you're developing a stream of income outside the operating budget that ultimately can pay for your capital work. Is this? See, Jim, this is why I almost wish everybody's mic were on, because I like being able to
Well, what I want to do is
deal with what comes
radical.
back after I make a statement like that.
And
Which is
all you
outrageous.
have is me, and I've heard you say these things before, and it still is challenging. I would like for people to type in a question or a comment that they might have about this, because this is a radical position, but one which has been espoused for a number of nonprofits, especially those nonprofits which have significant facilities. And just to underscore, Jerry, I mean, you are recommending that people seek to move to having endowments to help
Yes.
care for buildings,
Yes.
so that a capital reserve on an ongoing basis may not need to be as high. Or would you like
Almost
to elaborate?
everybody, I would think, if you own a building, you need some way of funding the ongoing capital maintenance and capital replacement. I mean, you shouldn't need to have a capital campaign when the boiler goes out. You had 50 years to reserve for that, so that you could replace it when it happened. People will respond to capital campaigns that have to do with deferred maintenance, but it's much better to have a capital campaign that's forward-looking about, these are the great things that we want to do with the buildings to bring them up to speed in the 21st century, rather than, we've known the roof was going and we've watched it deteriorate and now it's failed, so I guess it's time to do a capital campaign. How do we determine the amount needed to budget for repairs? Regular ongoing maintenance repairs, you have to see what your experience has been. I'm talking about things like, replacing the occasional light fixture, painting a room that's gotten, a little tired or something like that. The way to think about capital replacement, to be able to replace elements that wear out, to be able to maintain the elements that you have so that they reach their natural life. In other words, if you have wood trim around your windows, the wood trim can last 250 years, but you have to paint it every 5 to 10 years so that it doesn't deteriorate. Your failure to spend a couple $1,000s painting the exterior woodwork can reduce the useful life of that wood by 90%. So that amount is, I tell you, take the replacement value that's on your insurance policy, multiply it by 0.025. It'll give you a number that will suck the air out of your lungs. And then you think, okay, I can't do that much money, but I can do this much this year, and we can do that much next year, and we're going to start a planned giving effort. We're going to tell people that all of their bequests, 100% of their bequests, are going to be treated as principal contributions to an endowment fund to take care of the buildings that they love, where they've celebrated the major events of their lives, and it'll keep the buildings going for another 200 years. That's a way to move forward.
Jerry, I know we have some other questions. I just want to have you answer one, and then let's move on to our final slides. I posted one from Kathy Kerr about maintenance being a part of your capital campaign when a new building is built, which I think is a good idea.
This is a good idea. It is, and I think that some capital campaigns have been successful raising endowment funds. If there's a lot of deferred maintenance in your capital campaign, it's going to be difficult to raise the endowment funds because people are going to, understand that it's more important, or they're going to feel that it's more important to do the work that has been let go than to try to raise endowments. But absolutely. I think, though, most of your capital endowment, your endowment for your buildings, is going to come from your planned giving efforts, not from capital campaigns.
Okay.
People want to see the physical, tangible results of the capital campaign. Okay, these are some other things. If you have staff, clergy, a clergy person, organist, secretary, sexton, do not just give them money. You have to process it through payroll. Don't do the payroll in-house. It's too complicated and the liabilities are too great if you are late with a quarterly filing or a tax payment or something. Many dioceses process payroll for parishes, and the Church Pension Group has a program that any parish can go to the Church Pension Group directly, and set up professional payroll processing. It's cheap. You get national pricing. You're not paying as much as you would if you called a payroll vendor yourself. But get the payroll out so that it's not your responsibility to make those tax filings and do those year-end statements. And don't just give people money. Don't pay people. Don't say, well, the organist wants to be treated as a 1099 contractor. It really doesn't matter what the organist wants. The IRS has other ideas about who's an employee and who's a contractor, and it's almost impossible for an organist to meet the tests that make that person actually a contractor. You want to be, if you're employing anybody for 20 hours a week or more, you want to make sure that you're providing the pension benefits that are mandated for lay employees by the canons of the church. And if anybody is working 30 hours a week, you want to make sure that they're getting the medical coverage that's mandated by the church canons. Your diocesan administrator can probably help to make sure that you're in compliance with these things. And whatever your audit requirement is in your diocese, look forward to doing it. An audit is a great time to be accountable, and it's sometimes an astringent experience, but it's important, and we have to want not just to be good stewards, but to be seen to be good stewards of the assets that the parish has entrusted to us. And so doing whatever the audit requirement is and following up and fixing whatever it is that's not best practice in your financial operation is part of your ministry. It's part of your ministry. It's part of being accountable to the wider church and to people. And so now I'm going to turn it back over to Jim. Wow.
That was great, Jerry. Just one quick question that I posted for you, which I think I have an answer. I presume you would have the same, that it is useful to keep funds set aside for capital improvements into a separate account.
In a separate account. Capital
idea.
reserve
And it certainly is for accounting and auditing reasons, as you just mentioned.
And I just want to say one more thing, because we're all atomized. We're not in a room together where you can see other people and stuff like that. If anything that I said made you feel like, oh my gosh, we're not doing it right, and we're probably the only parish in the entire world that's not doing it right, that's why these things have their limitations. Because if we were all together, you'd see that everybody's in the same resource, in the same place. We're all way far away from the Emerald City. But now we know where the yellow brick road begins, and we can start moving. And every step we take is a step forward.
Well, thank you for that Ozian image. I very much appreciate that. And Jerry, thanks. Jerry's a tremendous resource to the entire church and is very active working with parishes and dioceses in helping them think through many of the issues we've addressed tonight, plus in the area of capital campaigns and annual giving, and has done just some wonderful work here at the Episcopal Church Foundation. And we are so grateful that he is a resource to us and that we can make him a resource to you in the wider Episcopal Church. There are obviously, as a goal of what ECF tries to do, we seek to share resources in a cost-effective manner with everyone throughout the church. And there's a listing up on the screen right now. Please do check out ecfvp.org. It's a fantastic resource. It's where we hold all of our recorded webinars on all of our topics, in addition to a tremendous amount of information that you can get from various resources we have posted there, from articles that have been posted, or from things that have happened in a parish and the stories that they're sharing. As I mentioned before, we're a main resource for the entire church in the area of planned giving, and the resource up there is one which donors can use. You can also access a number of resources on the episcopalfoundation.org website for the areas that we've mentioned in planned giving, endowments, capital campaigns, and annual stewardship. You can also download a manual of business methods in church affairs from the Episcopal Church itself, from episcopalchurch.org/finance. And there are some fantastic books out there, and they happen to be written by your speaker today, by Jerry Kuchar. And you certainly can check them out at your leisure. They're quite wonderful. They are quite challenging, but I do recommend you check those out. And finally, the Episcopal Network for Stewardship is a fantastic resource for annual giving and annual stewardship, and you can certainly check on their website for more resources. We have a number of webinars recorded, which you're certainly welcome to listen to on ecfvp.org. And there is a word missing from the first title of our next upcoming webinar. It's Communications for Episcopal Leaders on October the 15th, another on Leading Major Change on the 22nd, and on October the 29th, there is one on the basics of endowments. And all of you are certainly welcome. All of these webinars are free. The Episcopal Church Foundation creates these so that we can empower the leadership of the Episcopal Church. That is our mission, and we've sought to do it for the past 62 years. And Jerry and I are very happy to support that mission whenever we can, every day that we come into work. So thank you all for attending this evening. As I said, this is a recorded webinar, and we will be sending you a link to the recording shortly. I apologize for the initial problems with audio at the beginning, if you had heard them, but it was stopping me from being able to actually be heard, I think. So apologize for that awkward beginning, but thank you all for coming tonight, and blessings on either your drive home from a vestry meeting listening to us, or to go relax with a glass of wine. So, and that's what I'm recommending for Jerry Kuchar, who gets the last word for our webinar tonight. Jerry, any final comments to share with people?
Well, no, I'm just seeing that there's some comments and other questions that I wasn't able to answer. If you send those to Jim, he'll make sure that they get to me. I see one from Father Scarborough. And I hate leaving questions out there unanswered, but I know that we have to stop right now. We're at the end of our time. But thank you very much. This is and I hope, if it was challenging, I hope it wasn't overpowering. We can do this. We can
Absolutely.
Take one step at a time.
So thank you all for coming. Thank you, Jerry. God bless. Have a wonderful evening, everyone. Good night.
Thank you.